Welcome to the Review of Accounting Studies 2021 conference held virtually at USC. I'm Patricia Desho, Managing Editor of Review of Accounting Studies. And I would like to go ahead and introduce you to Bill Holder, who's the Dean at the Leventhal School of Accounting at USC. And he'll give us a few welcoming remarks.
Thank you, Patty. Good morning, all, and welcome to this RAST conference focusing on sustainability. At USC and the Leventhal School, we're thrilled to be hosting this innovative program. The impact of corporate action on the environment and society has led to growing demand for information on key non-financial metrics, such as carbon emissions, treatments of employees. The recent formation of the International Sustainability Standards Board also indicates that accounting and auditing can play a key role in providing and verifying this information. As researchers, we can help society by evaluating the usefulness of disclosures, understanding their influence on various stakeholders, and increasing the accountability of corporations. As accountants, I believe we're exceptionally well positioned to serve our society in significant part due to our long heritage of striving to provide information that has decision utility. For example, the work done to understand and enhance the decision utility of financial performance information will no doubt provide valuable guidance in these new endeavors. The attributes of representational faithfulness or reliability, relevance, pertinence to the decisions being made, objectivity and judicial impartiality seem timeless to me and applicable to a broad range of information. So let's begin. The first panel is moderated by Professor Regina Wittenberg-Moerman. Regina, it's all yours.
Hello, everyone. I would like to welcome you to the first session of the RAST conference at USC. And I will be moderating this first session with the help of AJ Chen, our PhD student. Before we start, I would like to go through a few housekeeping rules with you. Unfortunately, I don't see the slides. Yeah, thank you so much. So first of all, keep your microphones muted all the time. We don't allow personal recording. We have a different setup than you may be used to at other conferences. The chat is only for you to communicate with the host. Questions are not accepted in a chat, and you shouldn't expect in-time responses from the co-authors so that everybody can focus on the presentation. Of course, all the questions are welcome, but we would like you to submit them through the Google form, and the link is in the chat. As a moderator, and every other moderator during the conference, we will try our best to process all your questions and ask the most interesting and the most relevant questions by the end of the session. I apologize that moderators will not be able to ask all questions submitted through the forum, but we will make sure that the authors receive them by the end of the conference. The REMA hospitality room is open during the entire conference and all the sessions. Feel free to sneak out, talk to your co-authors and friends you haven't seen for a long time, as long as sufficient number of participants stay in the session so we have enough of a good questions to ask. And the next slide, please. Just to remind you about the format, the presenters have 20 minutes, the discussants will have 15 minutes, and then we'll have a short Q&A session for 10 minutes. And as I just said, reminder, the Google form is in the chat. Feel free to submit questions through the entire session. And before we start, we would like to thank the sponsor of our conference, Cambridge Business Publishers. I'm sure many of you used their books before. They publish books and help us with online resources for a variety of accounting classes. We encourage you to consider their books and online resources for your future classes that you will be teaching. starting next semester. And if you have any questions, please contact George Versman at cambridgepub.com. I'm sure many of you met George in good old days when we had conferences in person, and hopefully we have a chance to talk to him again when we get back to some sort of normality and have conferences in person going forward. And at this point, I think we are ready for our first session. So our first session is Walking the Walk, a bank ESG disclosure and home mortgage lending. The paper is by Sudipta Basu, who will be presenter, as well as Justin Vitanza, Wei Wong, and Ross Zhu. And Lukas Pomorski from AQR will be the discussant for this session. Lukas and I overlap at Chicago PhD program for 4 years, where Lukas did his PhD in finance. And I'm very happy to see you at our accounting conference at USC. And Sudipta, the floor or the Zoom is yours.
Thank you to the conference organizers for inviting us and our paper. And also want to thank Rosita Alvarado for all the conference arrangements. Scott Richardson as editor for sort of reviewing the paper, an anonymous reviewer who's given us a lot of good suggestions. And in anticipation, I hope the discussant. Okay. So trouble with trying to rehearse ahead of time. Okay, I think we're at the beginning. Okay, so how did we get here? So it's a long and winding road. Justin and Wei joined the Fox School in 2017 as new professors. One was in finance, one was in accounting. They crossed the hall from each other and they both did dissertations in banking. And so they decided we should write a joint paper. So they decided to look at CSR, which is a finance topic, and loan loss timeliness, an accounting measure, and see if they could find a relation. And they were expecting that good ESG banks, high ESG banks would have high loan loss timeliness. Unfortunately, they couldn't find any relation. So then they called me in to sort of try to figure out what's going on. We discovered that the loan timeliness measure was misspecified. That led to a JE paper. But then we were stuck with what to do with this paper. So we looked for a more banking related paper, which led us to mortgage lending in low income areas. Okay. And then Ross has joined us later as we've sort of tried to get more refined in our tests. So the question we were asking is, do high ESG banks lend more in low income areas to low income people? Because we know there's this a lot of talk about payday loans and these non-bankers ripping off poor people. And this is sort of potentially a reason why the federal government subsidizes banks by deposit insurance and lend of last resort and all of that stuff. Okay, so we went in expecting that high ESG banks would be doing good work, right? And so the banking industry is nice because they give you very detailed geographical data. So this is a map of the US. And if you've been looking at election results, you know that you can track elections down to the county level, right? And so here's a map of poverty levels for US counties. And sort of the red is the poor, the yellow is the rich. You can see the Southeast is poor, Mexican border is poor. Sort of New England and upper sort of Midwest is rich, relatively speaking. And then we plotted the ESG, the bank share weighted by ESG for the same counties, right? And what we see is an apparent inversion. So the rich Midwest has a lot of high ESG banks. The poor Southeast seems to have a lot of low ESG banks, relatively speaking. Now, it's difficult to sort of do this sort of inverse correlation with colors. So we've decided that we're going to go forward with an inverted scale for poverty, so you can sort of map red to red more easily, yellow to yellow more easily. But the version I showed you was the version in the paper. Going forward, we're going to switch to this. So you can see again that the Midwest is red, the Southeast is yellow. So it sort of says that high ESG banks tend to be lending in richer counties in the US. So the answer to our sort of initial question is no. But the banks give us even more detailed data. So we're used to county data at the election level, but for banks, we can go down to the zip code within counties and even one level down to census tracts within the zip codes. Okay? So for different tests, we have different levels of disaggregation. So here's Bucks County, Pennsylvania, which is to the northeast of Philadelphia. Again, the poverty levels and the ESG. And you can sort of see that in the southeast, near the Philadelphia border, there is more high ESG banks and more rich communities. Okay? If you look near New York City, across the Hudson, Jersey City, and so on, you can see similar patterns. Okay, so there are correlations, but obviously they're not 100%. So then we need to go to the data to sort of examine how close we are in sort of more statistical terms. But here's sort of the big picture idea that if you go down, even at the micro level, you can see sort of patterns in the data. Okay, so why are we looking at this? Well, we know that CSR has been hot for the last decade. Everyone's reporting ESG, social responsibility reports. Banks are doing a lot in promoting ESG, whether issuing bonds themselves or underwriting bonds, green bonds, socially linked bonds, and so on. BlackRock has sent out the Dear CEO letter saying we're not going to invest in companies that do fossil fuel and other bad stuff. And then, of course, there's that sort of affirmative claim that banks have from bank regulators that banks should be serving underserved communities. So that's the sort of the social signaling hypothesis that high ESG banks will be doing this stuff. And then on the flip side, there's a social wash that this may be all for show, but not reality. So Wells Fargo in 2016 had really fantastic sustainability report where they said they're lending to the most poor people, all of that. But then behind the scenes, their employees were just creating new accounts for people who didn't want accounts and so on. So there may not be a mapping between what they're saying and what they're doing, talking the talk versus walking the walk. Okay, so why might there be talking the talk but not walking the walk? Well, there may be benefits from talking the talk, such as pressure from Wall Street politicians, consumers, and so on, to have this image of being responsible, but it might not help the bottom line. So if they are aligned, then obviously the banks would jump in, but if it is costly to do this, then they've got to sort of trade off the benefits from this good image against the costs of actually doing something. Okay? And so it could be that they're faking it. So how do we go about studying this then? Well, we look within each county year, or in some tests, even more micro tract year. What share of the loans, mortgage loans in that county are being made by high ESG banks? And we're especially interested in whether these high ESG banks tend to lend more in these poor counties or poor census tracts relative to rich ones. Okay? Because we view this as sort of a very important sort of summary measure of their social work. As you can see, the dependent variable is the share, either number of loans or total dollar loans. And the ESG ratings come from Refinitiv, Thomson Reuters. These are the controversy adjusted ratings. So normally bigger firms tend to have higher ratings, but Refinitiv does an adjustment for bad publicity, which tends to bring down the ratings of these sort of bigger firms. Okay? So we take these, but we've sort of replicated the study. It's an appendix with Bloomberg, S&P Global, and KLD MSCI, and we get similar directions in all of those data sets as well. And then we take the county poverty level data from the Census Bureau. In the regression, you might spot that we don't have a main effect for county poverty. That's because the county by year fixed effect absorbs that county poverty level at the census, at the county year level. And so we're most interested in this interacted coefficient, which is this interaction positive or negative? To collect data, we take this ESG data from Refinitiv. We take mortgage data from HMDA, and we standardize on single family loans, convention homes, so no holiday homes, et cetera, something that's very comparable. We aggregate to a county year or a bank census tract year and require that at least 2 banks lend in that county year or in that tract year. So we are comparing within each county, and we're going to have county year fixed effects so that we're looking at within county year or within tract year comparisons. And then finally, we get bank data from the call reports. I should point out that the tracks are the CRA assessment tracks. So each bank is required to name some tracks, identify some tracks that they will be evaluated on for the Community Reinvestment Act purposes. So these are usually some of the poor areas around the headquarters. Okay? But they don't have to be, but it would be weird if you had only rich tracks in your assessment area, given that they're trying to assess whether you're making poor people better off. Okay, so here's the first table. We're looking at the number of shares as a function of your ESG score and your the county poverty level with a bunch of controls. And we find that there's a strong negative correlation. The first 2 columns don't have bank fixed effects, so they're looking at both pooled and cross-sectional variation. The ESG only columns, there's no relation, but once we put in county poverty, then there's a strong slope on this county poverty. Okay, and then we go over to the right, we put in the bank fixed effects, then we're looking within banks over time because the ESG scores change over time, poverty scores can change over time, and we get sort of similar coefficients. And we get essentially the same results when we look at the dollar share as opposed to number of loans. If we sort of do this by decile, we plot these scores by decile, what we see is that it's a fairly monotonic pattern. So it's not just driven by outliers. So that slope is not driven by outliers, it's a fairly monotonic relation. So then we drop down 1 level to census tracts. So we're going down from the county level to the zip code level, 1 more level down to the census tract level. Okay, and we're looking at the CRA tracts that the banks themselves have identified as places where they want to be evaluated on their sort of service of underserved communities. So the first thing to note is that like the first table, there's no relation initially between ESG and sort of lending. But once we put in poverty, the same kind of measure that we constructed before at the tract level, then we find a strong negative relation. But these are our constructed measures. Fortunately, the government has its own designations of which areas especially need help. So one is distressed census tracts, and the second one is underserved census tracts. And so we use the government measures of which tracts banks should be focusing on for CRA purposes. And in both of those as well, we find the strong negative relation between ESG banks, their lending, and the poverty level. Okay, so then we want to try to get to some sort of causal inference. So we're not going to be able to do anything perfect, but we're making an attempt with some quasi-exogenous shocks first. So what we look at are hurricanes, severe hurricanes, where there's a lot of property destruction, and therefore residents need loans to rebuild their lives, rebuild their homes, and so on. And what we do is we do that same test, but now we're doing some dynamic analysis. So we look at the 3 years before to 3 years after a hurricane, a severe hurricane, where we're getting the hurricane data from the NOAA. We look at the counties that are especially hit by the hurricane from FEMA, the emergency management people. And we look at only counties where banks were serving before the hurricane, so that we can look at whether they stay in, whether they cut their share, or they leave the county. Okay. And what we observe is whether we look at all hurricanes or hurricanes excluding the worst one, Katrina, we find that there's a negative relation again, and if anything, that increases after these hurricanes, especially in year 2. So they reduce their share relative to low ESG banks. If you do sort of a time series type of plot of the difference, we see that there is some decreasing pattern in front, but there's a big drop down, especially in year 2. So it is very difficult to assess parallel trends. That's sort of what we need for the post period, what would have happened if we didn't have the shock. But at least this is some evidence that they change their behavior around severe hurricanes. Okay, so then we try a different approach, which is an instrumental variable approach. And here we're trying to look at whether banks are trying to sort of serve their clients. And if their clients or their voters in that county are more likely to prefer ESG, maybe those banks do more lending there. So we sort of instrument ESG demand using the share of voters for the Democratic presidential candidate in the most recent presidential election. Now this because banks have been in the same location for decades, for the most part, they don't change the headquarters, but the electorate changes over time, and so this might provide variation that's exogenous to the bank. So if we first check the relevance condition, and we find that the Democratic percentage of the vote does predict the ESG score of the bank in its headquarters. So the Democratic percentage of votes in the headquarter county or state predicts the ESG rating. And then when we use that as the instrument in our second stage, we find again that there's a strong negative relation between the poverty rate and the ESG rating in terms of loan share. We get the same thing if we do this at the census tract level. We haven't reported it, but it's the same idea. Okay, so what can be done? Well, do the CRA exams actually work? So they're intended to make sure that banks are walking the walk. So if you don't pass these exams, then you can be barred from expansion. You might be barred from doing some of the things that you're already doing that were more profitable and so on. So banks probably need to pay attention to these CRA exams. So if this CRA examination system and enforcement is strong, then we would expect to see that after a CRA exam, things improve. And indeed, what we find is that banks that are rated outstanding tend to perform better or lend more in poor counties. This is sort of showing that at least the CRA exams seem to be picking up the right behavior. Okay, so now the review is very helpful and helped us think about, okay, you've found some evidence that seems consistent with your story, but obviously there may be other explanations. So let's at least try to put those on the ground and see if those explanations might work as well instead of your social watch story. So one possibility the reviewer suggested was that low ESG banks are quicker to respond to the CRA downgrades because they have more to lose. The high ESG banks already have good reputations, they have nothing to fix. And so we look at that, and what we find is that in the 2 years after a downgrade, it's the high ESG banks that respond by improving their lending or incremental to the low ESG banks. So it's not that the low ESG banks are responding to these ratings, it's the high ESG banks that are responding. A second explanation is that high ESG banks just have better underwriting standards, right? So they tend to loan to the good risks, and the low ESG banks have poor standards, so they tend to lend to low risk and high risk people, and then they have higher default rates and so on. So we look at the correlation between ESG and non-performing loans, or ESG and net charge-offs by high ESG versus low ESG. And we find that there's very sort of little relation between them. The difference is also not statistically significant for what matters. But even before that, when we look at the applicants for the loan, so it might be that they're getting different applicants. So we regress ESG on characteristics of loan applicants, and that's in the appendix, income, race, gender, employment, marital history, all that stuff. We find there's essentially no difference in the applications that they're getting either. So to us, at least, it doesn't seem like there's strong evidence that the high ESG banks have very different mortgage underwriting standards. Okay, another possibility is that the ESG data is crap, right? So we're using Thomson Reuters thing, and we've sort of already cross-checked with the other ESG providers, but maybe they're not focusing on the right things for what we are looking at. So maybe it's that they don't look at low-income lending as important in their ratings. So to look at that, we look at how does the ESG score of a bank correlate with its CRA rating, where the CRA rating is the most recent CRA rating they've received, and with their low income lending intensity. So this is sort of how much do they lend in poor counties. Okay. And we find that the CRA rating and in the most recent year and its lending in low income communities in the most recent year both positively correlate with the ESG scores. So ESG scores are definitely picking up some of the things we want them to pick up. And especially if both are going on, then the interaction term is very strongly positive, but that low income lending term then becomes negative. So that's consistent with the poverty rate information I was showing you earlier. So it seems to be the CRA rating that really matters a lot here. Okay. Another possibility is that instead of lending mortgages, they're doing other good things in the community. So they're making investments in startup companies, or they're making investments in community centers, things like that. So what we do is we look at the public welfare investment share in the county here. So again, this is separate data that is reported. And we look at that and its interactions with ESG and poverty, and finally the three-way interaction. And we find that the ESG poverty thing survives after we control for this poverty sort of public welfare investment share. So high ESG banks lend less in poor counties where they hold fewer public welfare investments. So it's not a substitution, it's actually complementary. They do both, less of both in poor counties where they have deposits, where they're taking deposits, but they're lending less and investing less in the same communities. We run a whole bunch of alternative tests, additional tests. So maybe the big banks like Citibank is serving poor communities in Kenya or Egypt or wherever. We throw out the big banks, we get the same results. We look at other kinds of loans. We look at, we already talked about the individual mortgage level analysis. We look at disproportionate share in of branches. We look at states where banks have more or less equal shares, so it's not being dominated, it's not one dominant bank. And we find that we get the results there. We look at the 4 biggest states, so Pennsylvania, Texas, New York, California. And in all of those states, we get the same result. And New York and California at least would be counted as reliably democratic states for the most part, although the rural areas are different. But we've tried to sort of go and look for cases where we might find the opposite. Okay. So I know I've rushed through the slides a little bit, but I think that gives the discussant and Q&A more time. To conclude, we find that high ESG banks lend less in poor neighborhoods than low ESG banks at the county and at the census tract level. So really micro data. This gap doesn't seem to be driven by different underwriting standards, alternative investments, but it does seem to be affected by CRA enforcement, and it seems to be worse after severe hurricanes, which are at least quasi-exogenous. So what do we take away? ESG disclosures don't always reflect true actions. What we've documented is only an average result at the end of the day. But to the extent that we found some positive effects of CRA enforcement, maybe we can do more along those lines to make sure that we hold banks' feet to the fire if they're making claims. Investors should be cautious in investing in ESG-oriented bank funds. We are not saying that everyone should lend in poor areas. We are saying that if you claim to be socially responsible and doing social good, then we would hold you to standard, but you don't have to be. You could be, the Gucci's of the world and not worry about it. If that's how you make money, that's fine with us, okay? But it's just matching actions to words. Last but not least, we're not the only ones worrying about this. So this last month, there's an article in the Wall Street Journal about, JP Morgan Chase selling green bonds and bond investors saying we're not going to invest in them because we don't really believe they're doing anything green. And similarly, social wash, which is the term we use, is also becoming sort of questioned, right? So are banks and firms actually doing what they claim? Or is it, they're just claiming it and we're using their ratings and then, we're not helping the environment or helping society through our investments. That's it. Hand back to Regina and look forward to comments and suggestions from Lukas.
Thanks so much. And Lukas, it's your turn.
Perfect. Thank you very much. And let me share my screen. So hopefully you can see it. And just shout if you don't. So first of all, thank you very much for the invitation. It's a pleasure to be here and discuss this paper. I will start with the usual disclaimers. I will talk about my own views. This may or may not coincide with whatever official stance AQR may or may not have on the paper itself. Let me start with a big question. So why do we care? Why is this an interesting paper? Well, it is because it talks about social washing. I'm gonna sometimes use the term greenwashing as well, which is a very popular term in the literature as well. It's something that is relevant for pretty much any kind of stakeholder that you can imagine here. It's relevant for academics, certainly for the accounting profession, because it talks about disclosure, about trying to detect companies that are maybe strategically manipulating their disclosures. It's important for finance. We learned something about banks. We learned something about a really important motivation that investors have when they assess how attractive a company is. That goes beyond the risk and return. Obviously, there's a policy angle here. There's a number of, outright regulations in Europe, for example, and some public comments that the SEC has made on the topic of greenwashing. There's a just social policy angle in terms of how to improve servicing the underbanked community, for example. So this is big. Okay, so I'm sold. I want to read this paper. I want to understand what it says. The paper, I will say, shows a slew of empirical tests, which are really skillfully executed. And I will say that I will not do justice to the paper because I will just not talk about this. I want to be on the record. The paper is extremely well done. You know, pretty much any question that I had is addressed somewhere in one of the tables, you know, somewhere in the paper. So kudos to the authors for that. Now, my role is to at least try to poke holes. So I will spend my 15 or so minutes trying to suggest some alternative explanations and maybe suggest some, it's not a weakness as such, but maybe give you a little bit more of a context for how to think about the incentives of actors in the space, of companies, of providers of ESG metrics, for example, and how it might change the interpretation of our of the results. The bottom line for me will be that this kind of smells like social washing, but I'm not sure that this is a smoking gun. I think there are certain possibilities that we may recover very similar patterns in the data without the underlying companies actually, again, strategically manipulating their disclosures. I will also say that one angle that is not really played up in the paper very much, but I think is a slam dunk, is that this is a paper that shows us something really important, insightful about what third-party ESG data actually means, what it is good for or not so good for. Either way, we learned something important here, so I would encourage everybody to take a look at the paper. It's worth it. Now, onto my trying to poke holes. Let me start with the definition of what social wash actually is. If you look at the paper, there's really two critical components of how we define social wash. First, you need to have firms talk about and maybe even undertake some symbolic activities. Emphasis on symbolic, fine. I don't think anybody would have an argument here. But then the second part of the definition is that these symbolic activities are meant to divert attention from weak lending records in poor areas. So this is extremely specialized. This is specialized to the research question that the paper is asking, which is fair. But I also want to acknowledge that if you talk about social wash, greenwash, any of these wash type activities, they're usually understood in a much bigger sense, that the dimension of weak lending record in poor area is going to be one of the many things that people care about. It's not the only thing that people might look at. So in principle, at least, if you undertake symbolic pro-social activities and then have a weak record somewhere else in other things that matter to investors, I would still call it a social wash, even though that company may actually have a strong lending record in the poor area. Now, I want to spend a moment on firms' incentives. Why would firms ever do this? Well, you may say that the answer is easy. Well, ESG is increasingly important to stakeholders. Maybe there is a correlation with the cost of capital. Maybe there's headline risk, considerations that banks may care about. Fine. But if that's the case, then I would expect that probably all banks would worry about their ESG scores, and to the extent that they can improve their ESG scores, the incentive is going to be maybe not as large, but certainly will be there also for banks that are actually doing all the right things, if their actually improvements matter. So it's really important in the context of the paper for the following reason. If you're one of the good banks, good in a sense that you actually have really strong social activities, you, for example, lend a lot in poor areas, then what is happening, what the paper shows, is that you actually are at a disadvantage because the ESG scores of the banks with really poor lending records are actually higher than yours. So if you're one of the good banks, then I would imagine you actually have some incentive to try to rectify the situation. So one of the questions that I don't think is resolved in the paper is how can we maintain the situation in equilibrium? I mean, if ESG scores are important, then they kind of have to be, otherwise we wouldn't have any social washing in the first place. Why do we arrive at a situation where the companies that are particularly bad on the dimensions that matter, lending in poor areas, arrive at meaningfully higher ESG ratings than companies that actually are doing something about it. And I think, part of the answer will probably be related to how those symbolic pro-social activities are identified in the paper. And as you saw from Sudipta's presentation, the identification here, a proxy, is really all about ESG data from third-party vendors. Okay, fine. I'll have something to say about this, but before I do, that's kind of the obvious data to look at, so I don't have a problem with this. But I also want to step back and ask about the incentives of those data providers. What are they in the business for? So what they deliver to their clients, which may include, corporations, may include asset managers, policymakers, many stakeholders. They need to inform those clients about the ESG dimensions that the clients care about. Okay, so what are these dimensions? So we'll talk about this in a moment. And then, if you talk to these data vendors, they will at least pay some lip service to, they are aware of social washing, they are aware of greenwashing, they try to take steps to disentangle whatever the company says from what actually happens with the company. So again, my question would be, how is it that, you would need to have some structural weakness, I think, on the part of multiple data vendors, because the paper is robust. They looked at a number of different data vendors to, again, arrive at this surprising situation where companies that don't score very well on the ESG dimension that the paper studies end up having pretty high ESG or even just S social scores from external vendors. So before we talk about the data a little bit more, you don't have to go to the third-party vendors. It's easier. And again, this is the obvious first thing to do. With unlimited resources that I think nobody really has, I would actually do it a little bit differently. So instead of looking at a proxy for what banks say, why don't we just look at the actual disclosures that the banks made? And this is something, this is more of an anecdote in the paper, but the paper actually does talk about it. And Sudipta actually mentioned this in the presentation. He's showing that at least in one case, Wells Fargo, which is a really well-known sort of case study here, we actually had a situation where the banks were basically over-promising on the ESG dimensions, and then we had a very clear sort of evidence in that one specific case that Wells Fargo at least certainly underdeveloped on most of its dimensions. Okay, so you could actually do this at scale. I'm not saying it's easy, but you could actually take a look at corporate social responsibility reports from multiple banks and start with a question: do they talk about lending in poor communities? So if they talk about lending in poor communities, and then you show that the banks that talk about this don't deliver, I think that's a smoking gun. Then you actually have a very direct evidence of social wash. You can also ask, that some banks have poor lending practices. So what do those banks actually talk about in the CSR reports? Do they try to hype up social activities outside of lending, for example? And maybe the answer is yes, and in which case, again, you would potentially have a very direct argument for social washing, with one caveat. You would probably also need to show that those banks overclaim such other dimensions. Because if they don't, then you have a situation where the bank is weak on one dimension, lending in poor countries, for example, but maybe they offset this by being particularly strong on something else that matters. Okay, so if there's multiple dimensions here, what are these? So the difficulty with ESG generally is that it's an umbrella term, and there's just about as many definitions of what ESG should mean as there are people who deal with ESG. But luckily, there are at least some frameworks. One of them is the SASB materiality framework that I think many people at this conference will be familiar with. So SASB is a kind of an NGO, an organization that tells you what dimensions of ESG, of sustainability, are important for different industries. Okay, so we can take a look for commercial banks. Commercial banks, have 5 relevant issues as per SASB, and I will say that some of them will pretty explicitly actually talk about what this paper studies. So for example, in the middle of my screen, you can see access and affordability. If you zoom in, you can actually see the definition of what it means. It means lending to unbanked, underbanked, etc., which is exactly what the paper does. So perfect. The paper talks about something that is important in this space, but there's a lot more. I will say that this is sometimes surprising to people. Data security is actually one of the social dimensions of ESG. And just a small aside, if you think back a few years ago, it was a very well-known publicized case of Equifax, not a bank perhaps, but they actually had a sort of massive data breach. And if you actually look at the ESG data provider statements around that time, many of them said, aha, we told you, Equifax actually had terrible ESG scores, and in particular, the S score was really poor. Why was it poor? Because many providers like MSCI, I think Analytics, actually thought before the controversy happened that Equifax was particularly poor on data protection, on privacy rights and such. So bottom line here is that there is more to even the S dimension of ESG than just lending to underbanked communities. You can also take a look at the kind of process of the data provider itself. So this is Refinitiv. I won't read everything here, but I'll just acknowledge that they do look at multiple dimensions of S, the social score that they arrive at for different banks. Actually, the single most important dimension, as per Refinitiv's website, is workforce. So workforce meaning the bank's own employees, for example. But the second most important is community. So again, you have to take a stand on: is it possible that a bank has really poor community score, for example, but such high workforce and other scores, but it still looks plausible on S or ESG overall? Is this greenwashing then, or is it just substituting one strong ESG activity for potentially a poor ESG activity?
Lukas, I'm sorry to interrupt. We're pretty much behind time, so I would like to keep some time for questions. I think Sudipta was a little behind on you too. So if
understood. I'll take 30
sorry about
seconds.
that.
So that's okay. So what I think, again, this is an underplayed part of the paper. What the paper delivers on in spades is being able to map ESG metrics from third parties to the actual outcome variables. And this is not the only paper that does it. There's actually a couple of papers on the program of this conference that also do it for different dimensions. I think this is actually the single biggest strength of the paper, because I don't have any concerns there. They deliver exactly on what they promise. And I'm going to wrap up. I will say that this is really cool paper, really strong findings. The only thing is that it may not be a smoking gun for greenwashing. Even so, I do believe it's an important paper that we learn from. Thank you.
Thank you so much, and sorry for interrupting. There are a lot of very, very interesting questions. I'll try my best to ask at least 3 of them and maybe take a little bit of your break. So the first question I would like was from Lindsay, and iterated from Michigan, and iterated by Christina from Wharton. It's like, we don't know what is the optimal amount of lending in these poor areas, and there's a possibility that some of this lending may be even predatory lending. And when I read the paper, I had a similar impression actually, because you show that some of the ESG banks, they credit Russian borrowers, but on average, they charge the same interest rate, which to me means they overcharge relative to other banks. And related to that, so who picks up the slack, right? Is it shadow banking? Is it possible that shadow banks, who actually are financed by banks in your sample, that pick up the slack, fintech companies? So this sort of social welfare is not very well it's not very clear. And as Christina also suggested, is it's possible that you look at the poor counties, but HMDA data allow you to go at the borrower level, and you can look specifically at income of each borrower, which can help you to address some of that.
So I'll let Wei jump in too, but we do look at the HMDA data at the individual applicant level, and we find that there isn't a difference in the applications and between the high ESG and low ESG banks, and there's not a difference in the interest rates except for jumbo loans, where the high ESG banks do originate a larger share. But it's that's consistent with serving rich clients rather than poor clients. That's it.
Yeah,
I agree that there's other intermediaries in the space, but that again is the last 5 years, maybe doesn't go back to the beginning of the sample period. But yeah, I mean, you can't control for everything. You do the best you can within the constraints of what data you have, I think.
Yeah,
Thank you for the question.
Yeah, maybe you can consider how to address predatory lending. Another question is, there's many questions like Shu from Duke and Matt from Miami that reiterate Lukas's concern that you're using third-party ratings. So what does it mean for the paper? Maybe the third-party ratings are just wrong ratings and banks do something good because you rely on them, or also why banks don't voluntarily disclose. Okay, we lend a lot to poor areas, and this means we are good ESG banks. So disclosures out there, they can disclose, voluntarily disclose how much they help poor counties, and it seems strange if they want to be perceived as high ESG banks, why they don't do it.
So they do disclose, as we point out in one of our slides, 88 of the top 100 banks have CSR reports, so they do it. But the problem is obviously that they're not standardized. So that's why Lukas says it's going to be a lot of work, right? Whereas here we have standardized data that we put through the ringer. The other thing is that we do confirm that the ESG data, these external providers' data does reflect sort of, the changes in the lending to poor areas. It does reflect the CRA exams and all of that. So it's not like they're uncorrelated or negatively correlated with the actions. They are positively correlated and significantly correlated. So I think that we don't have to claim that the data is bad. It's possible that the data is bad, but to the extent that we can, we verify that it is reflecting at least some of the activities that we are interested in.
I'll try one more. So there are many questions that talk about difference between high and low ESG banks. Thomas from Carnegie Mellon, Yada from Indiana, Daniel Benz from INSEAD, Matthias from Columbia. It feels like despite all your econometric approaches and bank fixed effects, there's some concern that these banks have just different value, like maximization functions. They have different strategies. They have different credit risk models. So maybe their risk models just lead to maximization of their profits because they know that in the poor areas, they're like higher default. And I know you control for default, but unfortunately default data is not at the county level. So you cannot prove that there are no higher defaults in the poor areas for low ESG banks. For example, another example that may be alternative explanation for Matthias, maybe this ESG banks just cater to richer clients in good areas because these clients care, and this is where they land, and this is how they try to attract clients from rich areas, but they just don't land, but they land last in a poor area because there nobody cares about ESG, and all this ESG disclosure or catering is to recruit clients in rich areas.
That's fine. That's a really great strategy for revenue boosting and profitability. The point is that you're saying something out of one side of your mouth and doing something from the other side. I mean, you're talking the talk, which is great, but you're not walking the walk in what you claim.
Yeah, just the idea they don't mislead.
Between the first three papers, right? All of us have the same title because we're all finding to a surprise that everyone's talking this great game, but they're not doing what they're saying they're doing.
All right, so unfortunately our time is over. There are a lot of very interesting questions. Sorry for not being able to address all of them, and we will forward to Sudipta and his co-authors. So thank you so much for Sudipta for excellent presentation, and Lukas for very, very interesting discussion. And at this point, we have 9 minutes left, 6 minutes left for the break, and we will see you for the next session at 9:05 for session 2.
Many thanks, Lukas and Regina. Thank you.